Hey guys, Take here. I'm going to be going over a whole lot of ICT concepts which will be divided into 4 categories: liquidity, premium discount arrays, miscellaneous, and entry models. There might be some things that I missed, but this video should be a comprehensive enough guide for any ICT trader at the beginner to intermediate level. Just as a disclaimer, these are my interpretations of ICT concepts, so it might not be exactly what Michael says. And with that out of the way, let's get straight into it. Firstly, we'll start with liquidity. Liquidity is essentially how much trading activity is happening at a certain price point. Liquidity pools are where buy and sell orders rest, and some liquidity pools hold more importance than others. This is a crucial aspect of trading ICT because whether it is true or not, we assume that markets move for 4 reasons: to hunt liquidity, generate liquidity, rebalance to equilibrium, and rebalance to inefficiencies. So now let's get into where liquidity rests and the different types and the significance of those liquidity pools. Firstly, we have to talk about swing points. These are a 3 candlestick formation where the high or low of the middle candle is either higher or lower than the high or low of the candles beside them. For example, if the middle candle's high is higher than the highs of the adjacent candles, then that makes a swing high. And if we have an opposite pattern, that makes a swing low. Above the swing highs and below the swing lows are where stop losses or orders will be placed. So these are considered levels of liquidity. People may refer to these levels as the drawn liquidity because we want to be taking trades in the direction of the most significant liquidity levels. Remember, one of the reasons that market moves is to hunt liquidity. In other words, go towards a liquidity pool. When there's liquidity above the current price level, it's called Buyside liquidity. Imagine that you went short, and then a reasonable place to put your stop loss would be above a swing high, right? And when you have a stop loss for a short position, you're placing a buy order because you have to buy back the position that you sold. That's why it's called buy-side liquidity. In the same way, liquidity below the current price level is called sell-side liquidity. Now we can start talking about the different types of swing points. We have short-term, intermediate term, and long-term swing highs and lows in the market. Short-term swing points are the exact same ones that we've been talking about. 3 candles with the one in the middle having a higher high or lower low than the adjacent ones. Intermediate swing points are ones where you have 3 short-term swing points and the one in the middle has to have the highest high or lowest low. It's just basically a swing point for swing points. And can you guess what a long-term swing point is? It's just 3 intermediate highs or lows with the one in the middle having the highest high or lowest low. However, certain liquidity pools have more significance than others, and in my opinion, one of the best liquidity pools are time-based liquidity pools. These are swing points that are formed based on a certain time period. I'll talk about Killzones later, but for now just know that the highest high and lowest low of the Killzones, previous day high or low, previous week high or low, and any other highs or lows based on time will, most of the time, hold more significance compared to a random high or low. Next is IRL and ERL. These stand for internal range liquidity and external range liquidity. These are exactly as they sound, and IRLs are swing points that form within a range, and ERLs are swing points at the extremes of a range. To give an example, if the previous day was your range that you're looking at, then the previous day high and previous day low would be your ERL, and anything in between them would be your IRL. But of course this depends on how you define your range, and this is something that you just have to develop over time because depending on how you view the market, the range that people see can be different. Now that we covered the basics of liquidity, let's move on to engineered liquidity. Remember the 4 reasons the market moves? One of them is to engineer liquidity. And by doing this, the market is manipulating and taking out all the participants on the wrong side and setting up for a strong reversal move. The first type of engineered liquidity is relative equal highs or relative equal lows. These are when you have swing highs or swing lows that are relatively within the same price range. And since you have orders above or below all of them, they create an area where there is a bunch of liquidity compared to just singular swing points. The same logic applies to equal highs or equal lows, where instead of multiple swing points that are relatively in the same price range, they are at the exact same levels. These liquidity pools are very good for placing your take profits because if you're wrong about where the market wants to go, then the price will usually reverse after sweeping this liquidity pool. For something that can help you determine whether prices wants to go higher or lower, you can try to identify low resistance liquidity. This is basically when you have multiple swing highs or lows in a row, creating a trend line. And you can think of this as basically a trend line breakout. All the built up liquidity will be used to rapidly move prices, and if you can get in on this move, you'll have a really clean trade. Lastly, we have liquidity voids. These are areas in price where there is a huge move to one side, and this indicates that there was overwhelming buying or selling pressure. And since the market wants to be in equilibrium and move efficiently, we can expect these huge gaps to be filled over time. Now we're moving on to premium and discount arrays. But firstly, we have to talk about what a premium and discount is. If we have a range, then the premium of the range would be the upper half, and the discount of the range would be the lower half. These arrays are levels where we would expect price to give some sort of reaction, depending on whether it is located in the premium of the range or the discount. In the premium, we would expect these arrays to have a higher probability to hold as bearish arrays, moving price lower. And in discount, we would expect these to have a higher probability to hold as bullish, pushing price higher. But of course, these concepts won't give a clean reaction every single time, so you have to identify the ones that are high probability, given the drawn liquidity and the overall context of the market. Firstly, we have fair value gaps. When you have 3 candles and the wicks of the first and last candles don't overlap, then you have a fair value gap. If the 3 candles move prices higher overall, then it's a bullish fair value gap, or a BISI, which stands for Buyside Imbalance, Sellside Inefficiency. And when the 3 candles move prices lower overall, then it's a bearish fair value gap, or a SIBI, meaning Sellside Imbalance, Buyside Inefficiency. While you can just call them bullish or bearish FVGs, the name BISI and SIBI explains why they form and why you could expect a reaction off of them. Suppose we have a BISI, or a buy-side imbalance, sell-side inefficiency. Then at this price level, the buying and selling have an imbalance where buyers are much stronger than sellers. This is because sell-side or sellers are inefficient and are not selling as much as the buyers are buying. And thus, buyers have to buy from sellers at higher prices, pushing prices higher. These FVGs can also be used as a liquidity pool and are considered a type of IRL. This is because the market wants to be efficient, and if there's an inefficiency, it would want to revisit that price level to attain efficiency. If you go even further, when we have a swing point inside of a FVG, then that automatically becomes an ITH or ITL, regardless of whether there are 2 short-term swing points adjacent to it. And to top it all off, the midpoint of the FVG is called the consequent encroachment, or CE. And if we wick into the FVG and instantly get a rejection before we even reach the CE, then that's a really good signature that price wants to just run towards the drawn liquidity. When we're moving in a range and then suddenly get a strong move while creating a FVG, we can expect that to be a breakaway gap. These are gaps that we expect to remain unfilled, and I like to use them as a place to put my stop loss. However, it is quite difficult to identify which gaps will remain unfilled, so you do need quite a bit of experience before being able to accurately identify them. When these FVGs are disrespected, then they turn into inversion fair value gaps, and you can expect them to work the same way as normal fair value gaps, but in the opposite direction. So if you have a bullish fair value gap that got disrespected, you would expect the inversion fair value gap to hold as a bearish PD array. For it to count as disrespected though, price can't just simply go above or below the fair value gap. It has to actually close above or below the fair value gap on the same time frame. For example, if there's a 5-minute bearish fair value gap, then there has to be a candle close above the fair value gap on the 5-minute. And if we just wick above and come back or close above on any other time frame, then it wouldn't count as a valid inversion. Another variation to this is called a BPR, or balanced price range. This is when you create an inversion fair value gap, but when disrespecting the initial fair value gap, you create another fair value gap. So you get an overlap of a bullish and bearish fair value gap. This is one of my most favorite PD arrays, and it can be used to anticipate a reaction off of it or as a strong level of liquidity. There's another PD array that's similar to these, but instead of using the gaps in a candle, we use the gaps between the candles. This is called a volume imbalance and is when the close of a candle and the open of the next candle are not at the exact same price. I don't use this one often, but identifying these volume imbalances on the higher time frame can help you frame your drawn liquidity for the day. Now let's move away from gaps and talk about order blocks. Bullish order blocks are a series of consecutive downward closing candles. And bearish order blocks are a series of consecutive upward closing candles. Technically, any candle could be considered an order block, but there are certain ones that are higher probability than others. For example, in the 2024 mentorship, ICT mentioned that if we have a fair value gap and we react off of it without digging into the midpoint, then create an order block, that is a high probability order block. Also, if we sweep liquidity before creating the order block, then that becomes a change in state of delivery, or CISD, which I consider to be higher probability than a regular order block, and increases in probability depending on how major the liquidity was. Additionally, while the strict definition includes the use of wicks, I like to just use the bodies of the candles for the order blocks. If we tap into an order block, respect it, and then create another order block off of it, that becomes a propulsion block. And from this, we can expect price to speed up in the direction of the drawn liquidity. Breaker blocks are similar to order blocks but differ slightly. Bullish breakers are the last up close candle before a down move to sweep liquidity, and bearish breakers are the last down close candle before an up move to sweep liquidity. Some people like to remember that the bullish breaker is formed from a low, high, lower low, and a higher high, and the bearish breaker as a high, low, higher high, and then a lower low. Breakers are one of my most used and favorite PD arrays for an entry, especially combined with fair value gaps. When these two align, it creates what's called a unicorn setup and is extremely high probability given that your read on drawn liquidity is correct. Don't expect this to happen too often though, because the name is given from the fact that this setup is rare. Mitigation blocks are essentially breaker blocks but without the liquidity sweep. Bullish mitigation blocks are formed from a low, high, higher low, higher high, and bearish mitigation blocks are formed from a high, low, lower high, and a lower low. I personally think these are just breaker blocks with a lower probability, but you might be able to find a good way to incorporate them into your strategy, so play around with them. I haven't done too much studying on rejection blocks, so I might be slightly off from what ICT teaches, but rejection blocks are just wicks with abnormal lengths at the extremes of the ranges. Usually, the rejection block is divided into quadrants, and we would expect price to react off of one of the quadrants. But you have to really be careful when using rejection blocks because you could easily get stopped out if your drawn liquidity is wrong and the high or low of the wick itself is the drawn liquidity. Vacuum blocks are pretty much liquidity voids, but the sudden price movement has to come from a news event. As much as this sounds dumb, we expect these to either remain as a breakaway gap or to completely get filled. So if you notice that price is just running away from the vacuum block, or that price is digging deep into the vacuum block, then you can use that to determine where you want to see price to go next. Next, we have new week opening gaps and new day opening gaps. These are gaps that are created from the inactivity period in the market. To mark out the new week opening gap, you want to look at the close of your last candle from Friday and the open of the first candle on Sunday, and that gap will be your new week opening gap. New day opening gaps have a similar idea, but you want to look at the close of the last candle of the previous day at 4:59 PM and the open of the first candle at 6 PM New York time. This is a concept that's explored with depth in the 2024 mentorship, and we can keep the last 5 new week opening gaps and new day opening gaps on the chart. We expect these to act as price magnets, which means that they are good drawn liquidity levels. Now we're moving on to the miscellaneous concepts. Yeah, I didn't really know what to categorize these as, but these concepts are definitely equally as important as the other ones, if not more. One of the most important concepts in ICT is time, because ICT concepts rely on time and price. One example of this would be Killzones. There are 4 Killzones throughout the day, which in New York time are the Asia Killzone between 8 PM to 12 AM, London Killzone between 2 AM to 5 AM, New York AM Killzone between 8:30 to 11 AM, and New York PM Killzone during 1:30 to 4 PM. These are when prices move with more volatility and logic, and it's when the algorithm operates. Another important time period are the macro times. These are the 10 minutes before and after each hour. So like 10:50 to 11:10 or 9:50 to 10:10. And you can expect an increase in volatility during these times. Judas swings are essentially a false breakout that takes out the participants in the market that are in the wrong direction before actually offering the correct move. You can usually see this happen before a strong move higher or lower, and the 9:30 market open usually injects a huge amount of volatility and forms a Judas swing. The Judas swing can be used in conjunction with AMD. This stands for accumulation, manipulation, and distribution, and is a huge part of allowing you to predict when large moves occur. AMD starts with accumulation, which is when price moves between a certain range and is chopping around. The manipulation is when price makes a false breakout to the other side of where you would expect price to go based on your analysis. Once we manipulate the people that are on the wrong side of the market, then we reverse and distribute towards where the market actually wants the price to go. However, using this does require you to have a good read on the bias and narrative of where price wants to go, so it might not be the easiest to use. Also, it's entirely possible that price just keeps accumulating. And the move that you think is manipulation may just be a part of creating a bigger range for accumulation. This is something that you need some experience to understand and filter out the good AMD versus the bad AMD. One very important way to use AMD is the session AMD. This means that we anticipate Asia session to accumulate, London to manipulate, and New York to distribute. This can help give you a bias on the higher time frame and is what I use to determine my bias most of the times. When we incorporate the element of time with AMD, we get PO3. This stands for power of 3, and this is the exact same as AMD but in context to a specific time element, such as the 4-hour candle, 9:30 open, or 10 AM open. When a candle forms, there's always the open, high, low, and then the close. We use this idea for higher time frame candles to create a structure for the lower time frame price movement. For example, at 10 AM, there's a new candle formed on every major time frame from the 1 minute to the 4-hour. This means that the 10 AM open price will be a key point of interest where we can base our trade idea off of. If we get a move lower without any move higher, then we can anticipate that the bottom wick on the 4-hour is starting to form, and the move higher will be offered to us later. This is because it's rare to see a candle form without a wick on both sides. Then we can apply our technical analysis to anticipate where price will reverse and try to get in on the move higher so that the 4-hour candle can create the high of the candle. This is essentially AMD, but we take into account the element of time. When we don't create a wick on either side of the candle, then that's called a devil's mark, and we expect that to be a good drawn liquidity because of what we just discussed about how it is rare to see a candle form without a wick. One way to anticipate when a reversal would happen is by using SMT Divergence. This stands for Smart Money Technique and is when a pair that is supposed to show correlation does not. For example, we would expect NQ and ES to be correlated since they are the Nasdaq, which tracks the top 100 companies, and the S&P, which tracks the top 500 companies in the US, with slight differences in the weighting or the industries and selection of the companies, but they are largely the same. When NQ and ES doesn't show correlation, in other words, the two move in different directions, then it may be an indication that one of them is lagging behind and will soon reverse in price. In order to see this correlation in the charts, you can look at the swing highs and swing lows. If, for example, NQ makes a swing low, then a lower low, but ES makes a swing low, then a higher low, then that is showing the lack of correlation and would be considered SMT. When we have a SMT at the lows, it is always a bullish SMT, and a SMT at the highs is always a bearish SMT, regardless of which instrument makes the higher high or lower low. In order to use this to the fullest potential, you have to combine it with other PD arrays and confluences. Optimal trade entry is a zone where you can look for high probability entries, but it has to align with what the bias is. To mark out the OTE, use the fib tool and make sure that the levels 0.62, 0.705, and 0.79 are on. The 0.705 is the OTE level, and if you can find a PD array that aligns with this level and gives you an entry that aligns with the bias, then it can be extremely high probability. The range between 0.62 and 0.79 is the range in which PD arrays are typically higher probability than in other ranges. This means that they are more likely to be respected and give a cleaner reaction. By adding the -1, -2, -2.5, -3.5, and -4 levels to the fib tool, you can mark out standard deviation projections as well. These are levels where you can expect price to retrace or to be the max expansion. In order to draw this out, you find a manipulation leg and use the fib tool to draw the projections. These projections are better when the manipulation legs are more major, so ones on the higher time frames or time-based ones such as the London session manipulation leg. The -1, -2, and -2.5 levels are retracement levels, where you can expect the overall trend to remain, but price to reverse slightly and give a retracement. The -3.5 and -4 levels are max expansion levels, and you would expect this to be at the end of the distribution move and is a good level for the final TP. Next, we got market maker models. The market maker model is a concept used to understand how price movements occur in the markets. It involves two main models, the market maker buy model and the market maker sell model. The market maker buy model starts with a consolidation at a low or discount price level. The market then moves up to a premium level, reverses, and eventually trades back below the original consolidation level. Essentially, it represents a cycle where price rises from a low point, reaches a peak, and then decline back to or below the starting point. The market maker sell model is the opposite, where we begin with a consolidation at a high or a premium price level. Then the market declines to a discount level, reverses, and trades back above the original consolidation. It depicts a cycle where prices fall from a high point, reaches a low, and then rise back to or above the starting point. The risk reward isn't specifically an ICT concept, but it'll give you some insight into what kind of statistics you should be aiming for and help manage emotions. For example, if you target a 1-to-1 R, then a 50% win rate will be break even. But anything slightly higher, even a 51% win rate, will give you positive profits over time. But if you make your target a 1-to-2R, then you only need a 33% win rate to be break even. And with a 1-to-3R, you only need a 25%. This can help you put things into perspective because if you're aiming for a 1-to-3R, then you should be expecting about 3 losses between each win. So don't get so emotional after 1 or 2 losses. If you think that you can't handle that many losses in a row, then try to just aim for a 1-to-1R because with a 1R, you should be expecting a win every other trade. Given that your system is completely random, if you have even the slightest edge, and you can increase the win rate to anything over 50%, then as long as you trust your edge and the statistics, you know that you will be in profits over time. So there's no reason to get emotional over some losses. An immediate rebalance is when a significant price movement, either upward or downward, is followed by the next candle retracing back inside of the previous candle's range. When the second candle immediately displaces in the original direction, then it's a strong sign that we will have continuation. Institutional order flow entry drill is a similar concept, but we need a fair value gap to be created first. When the next candle taps into the fair value gap and immediately reacts and displaces, that is the IOFED. Since the large institutional players had limits set on the fair value gap, the buying or selling made price displace quickly. It's quite hard to anticipate which fair value gap will offer an IOFED, but once you see this signature in price, you can look for another entry to be offered in the same direction. 3 drives is when there are 3 consecutive highs or lows, with each of them being higher or lower than the previous one. This indicates exhaustion in the buying or selling pressure, and can be a good place to look for reversals. Usually, you'll want to combine this with other concepts such as PD arrays and SMTs. A market structure shift indicates a shift in the narrative. For a bullish example, if we trade above the high that made the last swing low, then that would be considered a bullish market structure shift. And if we trade below the low that made the last swing high, then that would be a bearish market structure shift. ICT says that as long as we trade above or below, it's considered a market structure shift, but I like to wait for a candle close above or below for extra confluence. These market structure shifts are more important on the higher time frame, and if you're looking at the 1 minute, you might get faked out by the market structure shift that doesn't go along with the higher time frame bias. Institutional order flow, or just order flow in terms of ICT concepts, is essentially just looking at which PD arrays we've been respecting and violating. If we keep respecting bullish PD arrays and violating bearish ones, then we have bullish order flow. If we keep respecting bearish PD arrays and violating bullish PD arrays, then we have bearish order flow. Ideally, you want to be in longs when we have bullish order flow and shorts when we have bearish order flow. Finally, we're going to be talking about entry models. These will combine the things that I've explained in this video to create a strategy that you can start using. Firstly, we have the 2022 model. This is a model that was explained in the ICT 2022 mentorship. For this model, we want a liquidity sweep, market structure shift, and a retracement to a fair value gap. The entry will be off of the fair value gap, and the stop loss will be above or below the candle that created the fair value gap. The take profit will depend on the context, but you could use standard deviation levels or any good liquidity pool as the TP. When there are multiple FVGs, then the entry will depend on how much risk you want to take. Having the entry at the first fair value gap will give you an entry with the highest probability, but your stop loss will be larger. Having your entry at any of the other fair value gaps will give you a lower probability that you'll get the entry, but your stop loss will be tighter and you would have a better RR. This is a very simple model and can be really good if you get good at being able to analyze the higher time frame and the narrative. But if your read is not right, then those fair value gaps can easily get ran through. Next up, we got the silver bullet. I don't really like this entry, but it is one of the easiest entry models to use. The silver bullet entry is based off of the silver bullet time window, which is between 10 to 11 AM. And in this time window, you enter off of the first fair value gap that's created in direction with your high time frame bias. The stop would be above or below the candle that created the fair value gap, and you would target 2R. The reason that I don't like this entry is because I don't really like to enter just off of a fair value gap, and I like other confluences to be present when I'm taking an entry. And this last one isn't really much of an entry model, but I thought it would be worth mentioning. Turtle soups are essentially when you enter off of the manipulation leg in an AMD formation. This can be done by identifying strong liquidity pools that align with strong PD arrays, which will give a high probability of a reversal. The entry will be at the liquidity pool with a tight stop, and the TP would be at any swing points that make sense given the context of the markets. This entry has a very high RR, but it's also hard to consistently predict. However, there are some times when the turtle soup is as clear as day, so being able to identify and take these trades occasionally may benefit your trading. And that's it for the video. I hope this video was able to give you a good understanding of ICT concepts. And while it's not the most in-depth, I think that this video just alone is enough to really speed up your growth. This video took quite some time to make, so I'd appreciate if you could leave a like and subscribe. I got a Discord channel linked below, and I'm trying to create a nice community of transparent traders, so I'd also appreciate it if you could check that out as well. I've also made a Patreon, and if you guys could support me until I get consistently profitable, I'll be able to dedicate more time creating free value. And trust me, once I become consistently profitable, I'll definitely think of a way to give back. If you do have any videos you want to see, then make sure to leave them in the comments or the Discord, and hope you guys have a great time trading.